Okay, this video is going to look at international banking and how you transfer money from one place to another in a safe way, and how banking systems can actually allow you to do really good and how they can support you in doing even better. A bank holding company is a corporation that owns a controlling interest in one or more banks, but does not itself offer banking services. Holding companies do not run the day-to-day operations of the banks that they own. However, they exercise control over the management and the company's policies. Since the financial crisis of 2008, most U.S. banks, the large ones that is, are classified as bank holding companies. Bank holding companies are regulated by the Bank Holding Company Act of 1956. One important part is that the Federal Reserve and the Federal Reserve Board of Governors, under the regulation, has responsibility for regulating and supervising bank holding companies and their activities. As such, they have established capital standards, approving mergers, and other things such as acquiring other banks. The Federal Reserve also does inspections of the operations of bank holding companies. A bank holding company makes it easier for the firm to raise capital than traditional banks. The holding company makes it possible to assume debt of shareholders and are typically tax-free basis, or borrow money, acquire other banks and other non-bank entities easier. It also makes it easier for a bank holding company to have the authority to actually do share buybacks compared to other banks. Bank holding companies are also regulated that they have to register with the Securities and Exchange Commission, the SEC, and that adds another administrative burden on bank holding companies. Being tightly connected with the Federal Reserve Bank makes it easier for them to actually receive credit. Bank holding companies might have several different types of names. It could be seen as an international bank, an investment bank, universal bank, or a service bank. Sometimes they have lots of different names. They might even say that they're retail. Now, the difference is that international banks can be characterized by the types of services they provide that distinguish them from domestic banks. International banks are structured as a bank holding company, so they can perform both traditional and investment bank functions. Some of the common services that are offered to clients are international payment systems, foreign exchange, interest rate swaps, bond and equity underwriting, international cash management, letters of credit, trust account and compliance for mutual funds and exchange-traded funds. There are a lot of reasons for international banking. One is that it gives you a lower marginal cost. Managerial and marketing knowledge developed at home can be used abroad with low marginal costs. Another one is knowledge advantage. The foreign bank can draw on its parent bank's knowledge of personal contacts and credit investigations for use in that foreign market. Home nation information services. Local firms in a foreign market may be able to obtain more complete information on trade and financial markets in the multinational bank's home nation than it is possible to obtain from a foreign domestic bank. Sometimes there's regulatory advantages. Multinational banks are often not subject to the same regulations as domestic banks. Wholesale defensive strategy include banks follow their multinational customers abroad to avoid losing their business at home and abroad. A retail defensive strategy would be that the multinational bank also compete for retail services such as travelers checks, tourists, foreign business markets, and so on. From a corporate point of view, it gives you a risk reduction and greater stability of earnings due to diversification. It's naturally prestige is always a large part. Very large multinational banks have a high perceptive prestige value, which can be attractive to new clients. With prestige comes a positive reputation and reassures that you will actually get paid from the customer. International banking offers an opportunity of strong growth. Foreign markets may offer opportunities to grow in different ways compared that you might not be able to do in the same way in your home domestic country. Expanding your business in different geographical areas will allow you to overproduce and export your surplus. Transactional costs are sometimes decreased by allowing multinational banks use their system to circumvent government currency controls. For example, if you deposit money in India, you can withdraw it then in the United States and not follow the same rules that would apply if you would just take out the cash and try to put it on an airplane and fly it from India to the United States, where very strict rules are preventing that from happening. Offshore banking is very important. An offshore banking center is a country whose banking system is organized to permit external accounts beyond the normal scope of a local economic activity. And that means that the host country usually grants complete freedom from the host country's governmental banking regulation. It's a way to avoid strict rules. The International Monetary Fund recognizes the Bahamas, Cayman Islands, Hong Kong, Netherlands, Panama, and Singapore as offshore banking centers. In some cases, in order to go around a legal regulation, companies create shell branches. A shell branch can be nothing else but a P.O. box somewhere, and a service that goes there and checks on the P.O. box, scans the information, and emails it to the home company. The actual business is done by a parent bank at the parent bank. The purpose was to allow U.S. banks to compete internationally without the expense of setting up full operations for real. Now, one very important part for bank holding companies is having adequate capital standards. That means that the amount of equity, capital, and other securities that a bank holds as reserves. The three pillars of capital adequacy is minimum capital requirements, supervisory review process, effective use of market discipline. Now, they also are connected with the Federal Reserve that sometimes just mandates them to have X amount of cash on hand. A lot of these regulations came in effect from the financial crisis of 2007 and 2008 and resulted in the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act to promote financial stability in the United States and around the world. The idea was to end the whole idea of too big to fail, which requires American taxpayers to bail out organizations that did not do their proper fiduciary responsibility. I hope you liked this video, and if you did, give me and follow my page. I also suggest that you take a look at my playlist that has awesome, fantastic videos on stuff that you want to watch. Okay, lots of good econ stuff. People like Ray Dalio, Milton Friedman, Carl Icahn, Shark Tank, and other episodes that I think you're gonna totally enjoy and help you better understand the economic world that we live in. So, see you soon. Take care. Bye-bye.